In this video, we're going to have a look at 5 awesome strategies of growing the value of your money rather than watching it waste away in those rubbish cash accounts. Plus, at the end, we've got some top tips for getting involved without taking too much risk. Hi, I'm Marcus De Silva.
Hi, I'm Simon Longfellow.
And welcome to the Steps to Investing channel, where we help everyday folk learn how to invest sensibly and achieve financial freedom. If you are new here to the channel, just click the subscribe button and turn your notifications on. We release new videos every Monday. And if you have any comments or questions, just put them below the video and we'll get back to you as soon as we can. We'd love to help.
Now, we know interest rates are low and have been for some time, and we think you might well be sitting there thinking, how am I going to get a better return on my savings so that I can put my feet up and maybe even retire a little early? So in this video, we're going to look at investments which are designed to increase the value of your money. It's called capital growth, and that's distinct from investments that are looking to generate an income or preserve the value of your money. So in this video, we are talking about taking a little bit of risk. Now, there's no getting away from it. If you want returns, you're going to have to take some risk. You need to be comfortable with that. But one way to minimize those risks is to use investment funds from regulated investment fund managers. They will diversify your investment, meaning it's invested across lots of different things, and therefore you won't be taking exorbitant risks in search of those returns. So check out the other videos on funds in the channel. We've done a couple on how to choose funds and how funds work. But today we are talking about 5 strategies to increase the value of your money, to make capital gains, capital growth. But we're going to look at it across different levels of risk. Some will be lower. And at the end, though, we're going to come to a riskier version where you can really swing for the hills. Final thing to say, and it's important in the intro, is that all of these things that we're talking about are really easy. Investment funds can be purchased in minutes. You can open an account and buy within minutes. Please like and subscribe if you're enjoying the video.
Okay. Let's get on to it then. The first 3 ideas that we're going to give you are what they would refer to as mainstream stock market investments. So this is about investing in some shares. Now, the thing about shares as an asset class is it's generally seen as a little bit risky. It's riskier than other asset classes like cash or bonds. So expect prices to swing around a little bit, which is why the professional advice would be that you need at least 5 years as a minimum if you want to consider stock market investments. And we would say between 5 and 10, and actually the longer you leave them, the bigger your returns will be, because over time they compound up. Number 1, hot industries. These are funds or passive ETFs that are focused on very innovative, fast-growing sectors or subsectors of the economy. So what you'll find within an economy is that some industries, usually pretty new ones, are very innovative and capable of delivering new products and services that are very profitable, especially if they're protected by things like patents or if they're just very hard to copy. Now, there are some good examples. There's 2 classic industries over the past couple of decades that we can point to, and that has been healthcare and technology. In healthcare, if you develop a big blockbuster drug, it'll be patented for a while, which can mean fat profits for many years. A good example was Pfizer and their little blue pill Viagra back in the 90s, which generated billions of dollars of profits and very strong share price growth for Pfizer. In technology, well, just pick any of the big tech firms. I mean, Facebook basically managed to build an enormous multi-billion-dollar advertising network, which led to very strong growth of its share price. So if you pick a fund or an ETF that's focused on hot industries, on growth industries, that can be a really good way to grow your capital, to grow the value of your money.
Idea number 2. Have you thought about younger or smaller sized companies? Now, by smaller, we mean the value of those companies on the stock exchange. And the reason we're suggesting smaller companies, smaller, younger companies, is that they tend to have the capacity to grow more quickly than their larger blue chip counterparts. This is because as smaller companies, they're still adding lots of projects and hopefully sales and profits, that they're growing fast year on year. After all, it's easier to turn £1 into £2 than it is to turn £100 million into £200 million. Also, smaller businesses don't tend to pay out profits to shareholders. They tend to take those profits and reinvest them back into the business to help it grow even faster. So what makes a small company small? Well, actually, it's probably bigger than you think. All of the companies we're talking about here are listed on a public stock exchange. They're not going to be in the FTSE 100, that's the leading 100 companies in the UK, more likely to be in the FTSE 250, or even traded on the alternative investment market, which is AIM, really for small or fledgling companies. But remember, the smaller the firm, the higher the risk, although there is higher potential for returns.
Now, our third mainstream stock market idea is emerging markets. So emerging markets such as China or India generally have economies that are growing at a far faster rate than developed markets such as Britain and the US. On top of that, many industries and companies are also far less sophisticated and developed than they are in the West. What this translates into is lots of opportunities for some of these young emerging companies to go and get stuff done and chase profits, and therefore grow very fast, which should translate into strong share price growth. As with anything, this strong potential for return comes with risk. Because these economies are less developed, it means governments could potentially be more corrupt, infrastructure might be poor, which could hamper the activity of the business, there's a less strong rule of law, there's lots of factors that make emerging markets a little bit more risky, but with risk comes reward.
Okay, idea 4, and we're moving now into the alternative investment space because we're going to talk about property. Now, property can be great for capital growth, although it does have an income element as well from rents. But it represents a different asset class to stocks and shares. It's a different grouping of investment. That means it will diversify any investments you have on the stock exchange because the returns are based on different factors. Property also represents a lower risk investment than shares because the values of properties don't tend to fluctuate all that quickly or all that easily. Now, the good news is you don't need to go out and buy a flat or a house in order to invest in property. You can actually use a property fund, which allows you to access property without having to buy the physical building for yourself.
Okay, number 5, this is the hot stuff. This is the speculative, risky stuff. If you want to bat for a much bigger return over a shorter period of time, but buyer beware, you can also lose a fair bit of money as well. Now, as Simon was talking about in his bit about smaller companies, the smaller the company, the higher the risks, but also the higher the potential return. But this was all within the public stock markets. What you could do is go for them in an even earlier, younger stage when they're still private and haven't got to that stage where they float on a public stock market. Now, these types of private companies represent a lot more risk. You could use a fund to try and access these. These are generally referred to as private equity, or even younger than that is venture capital. So they'll be nice and diversified, or you could go direct and use something like an equity crowdfunding platform to buy the shares of private companies. Now, the other thing that you could do is go for much more speculative, risky assets. Think of things like CFDs or spread betting, or even foreign currency exchange, they sometimes call that Forex, and the all famous cryptocurrencies. But these represent a lot of risk and could lose quite a lot of money in a very short period of time. So make sure you treat it in that way. Never put a lot of money into these things, and make it an amount of money that you can actually afford to lose tomorrow.
Okay, well, thanks for sticking around. As promised, now are 3 bonus tips to getting involved without taking too much risk. Number 1 is to prepare your finances. Pay down any expensive debt that you have now, so credit cards is a good example, and make sure that you have a rainy day fund. 3 or 6 months salary kept in a savings account is a great idea. Tip number 2, markets tend to go up over the long term. So the more time you can give it, the better. We said 5 years as a minimum, 10 years is even better. And finally, top tip number 3, funds are grouped into sectors. So a group of funds that does a similar thing is called a sector. What we would recommend is diversification amongst sectors, that way reducing your risk.
Final thing to say is that we have a free 7-day email course. You just click the link in the description and sign up, and we'll send you 1 email per day with lots of interesting videos and articles and everything you know to learn the basics to get investing. We hope you enjoyed the show. Please subscribe. We'll see you next time.
Goodbye.